Hey, Blake, how you doing?
Good morning. Hey, I just want to say great call the last couple of days. You've been pretty unwavering as far as looking for dollar weakness. You watch bonds right now. Bonds are
I know.
screaming lower. Yields are flying, and the dollar is absolutely getting destroyed right now. And that's, to me, pretty crazy, actually.
That is.
Just to see the bond market just absolutely getting destroyed and yields just flying. I mean, yields are just screaming, and at some point you would think this is going to start to affect the stock market. You would think. I mean, you got S&Ps at all-time highs right now intraday, and the Nasdaq pushing higher, and it's pretty wild how much the dollar is really ignoring, or excuse me, the stock market's ignoring all of this move in the bond market.
I don't get that. That's got me scratching my head. I think that's kept the gold, even though the dollar's been weaker, the gold has been rather restrained in its move higher, and I think it's being impacted by rates. Look at the dollar index; it's still moving lower. Look at this, 93.89. Yep. We do have support today at 93.72, which is my intermediate target. As I discussed with you before, is what I had come up with was on this bar here. I just took that and moved it this way to break here, and when I got that break coming across, that pushed me around 92.80ish, or really like 75. So that's what I'm looking for, but with an intermediate pause at 93.72 when we're just about there. So we'll see how that comes about. But yeah, I'm surprised the S&Ps, and look at that, it's still pushing lower here. And that was my thinking. Really, it was because, as I kept saying, I was saying yesterday, reference to the 90s movie, Dude, Where's My Car? Dude, where's my rally? I mean, if bonds are coming apart and rates are going from here to the moon, where's my rally if I'm long the dollar? And you just weren't getting rewarded. So that's why I thought that people would just end up giving up their bullish dollar positions, and we would see this market roll over. And I guess that's what's taking place now.
So, we're coming up to the major 38% retracement for the euro dollar, which comes in at 117.80, and that's going to be
1782.
Yeah, we're like literally coming right up on it. So, you got to start being a little bit more careful if you're shorting the dollar, especially, it's like I'm sitting here watching stocks. I cannot figure out, at some point the stock market's going to bend and it's going to start to roll over. And I think this bond market move is the scary thing. This bond market move is probably, in my opinion, what's going to really start to, it's going to start to spook the market, and it's going to start to spook anybody who's dollar, like if you sold dollars today, now you got to start being a little bit more careful, because at any time, actually, you know what, I need to put in just a couple of quick orders really fast. Excuse me one second. Yeah, I think you got to be a little bit more careful here as far as, hold on. And gold just got up to highs too. Let's see. Sorry, just doing a couple of things really quick. So I think you have to be a little bit more careful, because with bonds just doing what they're doing right at the moment, it's going to start to spook stocks, I would think, really soon, actually, which might be as early as today. And then if that happens and the stock market starts to feel a little bit of pressure, then you got to start thinking, okay, well, is the dollar going to start to see some sort of bounce back? You know what I mean? And because the dollar is going to be responsive more on risk aversion, I think, than anything. And plus, you just got everybody just absolutely hammered in the dollar today, and now you're going to have, you know, you got all those dollar longs just got actually blown out of the market today. So what happens when, you know, they if they have to get back in, if the market starts to turn, if like equities start to turn, I guess is what I'm trying to say. So
I don't understand the S&Ps being up here with the bonds. You know, rates continue to keep moving higher and higher and higher. That's the thing. And one of the reasons why I'm not a believer of the dollar yen, it's still bullish as long as it's above the bias pivot, but this dollar yen should be well north of 113. So it reminds me of where the dollar index was, you know, a few days ago. And so I think if this S&P, if the S&P falls into, well, like I said, it's almost like a puzzle, like a domino. So we know that these rates are just in bad news. So if we do finally start to see the S&Ps react, then I think that will translate here into the dollar yen, and I think this dollar yen could start sliding on that, because now you already have the dollar that's weaker, and the dollar yen has not responded to rates. The only thing it's hanging its hat on right now is because the S&Ps are higher. If we do see a correction in the S&P, I think this is the one market that's susceptible over the next, you know, couple of weeks.
yeah, again, and I would agree with you on that. All right, well, I guess I can take over from here. It's just, man, this is a crazy market, I tell you.
It sure is.
Let me, yeah, it's wild. Let me grab the screen, and we're going to go over some of these. I know you've been covering all the majors right now, and by the way, this is investing.com day. So we have traders that are in from investing.com. So I want to welcome them all. Actually, I have a chart that I wanted to show you guys, because what I'm really concerned with at this point in time is I'm really concerned with the market taking note of this move in bonds. Now, right now, the dollar is ignoring it. You can see the dollar is obviously moving. You know, just it's moving lower. Everybody's getting squeezed out of their dollar longs. You got the euro dollar squeezing up towards 117.80, which I think is a big deal. But I think this move in the bond market, if you take a look at the here's the 10-year. You can see that actually I should probably go to this right here. Here's the 10-year really moving lower and trying to break down. Now at some point this is going to start to worry equities, and you got equities that are where's the S&P? It's up here. We're at intraday. We're at new highs. You know, you can see S&P's, you know, pushing up to new highs. Relative strength is divergent again, but you know, that hasn't stopped the market at all. But I have a pair that I'm actually watching pretty closely, because, you know, New Zealand had great GDP numbers. You know, I actually turned around. I was short the Kiwi yesterday. I took like a 5-pip loss, and I turned around and went long and did really well with it. I went long the Kiwi, looking for a move, you know, up, you know, into new trend highs, which I played it. Now I've got my eyes set, or my sights set, on the New Zealand yen, because the New Zealand yen, if you look at this weekly chart, okay, we had a broken weekly trend line, and that, you know, it's kept us under pressure really all of August and September. But here we are pushing right up against resistance here, and this is actually a couple types of resistance. We got channel resistance. Okay, then we have the underside of that trend line. So at this point in time, you have to be a little, well, I think that the relative strength, even on the 4 hours, up into pretty high territory. But I think it's due for a possible short up here, especially if equities start to feel some downside pressure. So which I think is going to happen. I mean, I know the market's squeezing pretty hard right now, but I think what we're going to see is we're going to see stocks actually start to show some downside a little bit later on this morning. You know, like after the stock market opens. I don't think I would be chasing the stock market higher at this stage in the game. Now, you know, Polly's gone over the euro pretty extensively, and we broke out of this wedge, and we actually just took out the 127% extension, you know, when we took stops above 117.50, and we are almost at, let me get rid of this blue line, these blue lines, because I was just showing you that we had a wedge pattern. It was going to break either or. So obviously today's break higher, you know, after we came through the wedge this morning, you know, it's taken us up towards this 117.80 level. Now this is a 38% retracement. Now if you know, if you want to know 38% retracement from what, that's from the highs that were set back earlier this year around the 125 and change level to the lows. We're at the 38% retracement. So I would expect that the euro starts to stall up at these prices. Okay, you got the euro rallying, you've got the dollar really selling off. You also have to keep in mind that silver and gold still haven't broken out. I think they're holding up relatively well, but they haven't broken out, and that's the thing. That's the one thing that kind of makes me believe that we could have this could all just be more of a stop loss run versus an actual move. You know, if I was sitting here looking at the euro dollar, okay, and I saw gold breaking through this resistance, which it hasn't yet. We've failed to do it over the course of the last few weeks. Silver is still being, you know, held hostage by the 1430 level, although we are, you know, trying to take out channel resistance this morning. But if silver and gold were higher, like today, like we were, you know, let's just say roughly, you know, 1% higher on a percent or two higher, I would be pretty gung-ho about buying the euro and expecting a move to, you know, 118 or whatever. But we're not seeing that, and so that is a little bit concerning to me. All right, it's concerning because, you know, I like to see these correlations take hold when I'm you know, taking positions in the market. So that's not happening right now, and that is a little bit concerning as the dollar continues to get liquidated. Now, speaking of the dollar index, you guys remember we were looking at this chart yesterday. We had a wedge, it broke down, and here we are, you know, coming into, same with the dollar index. Let me get rid of these lines. It's just pretty much reverse of the euro. The dollar index is coming into its 38% retracement that comes in around 93.50, 93.60. We're still making our way down there, so there's still some room for us to go. But again, you have to start being a little bit careful with the dollar as we're coming down here, especially we got bond yields ripping right now. I mean, you know, if you look at the 10-year yield, let's go over to the 10-year yield really quick. Where are we? I mean, you got yields ripping. How's the dollar not responding? And so right now, right now the dollar, like I said, the dollar's been very unresponsive to the move higher in yields, but I don't know if that's necessarily going to be the case all day long. So you know, just be careful, you know, with this dollar. I am looking to sell the euro dollar as we get to 117.88, and that is the, you know, 38%, or excuse me, it's the 38% retracement right up here. 161% extension of this wedge breakout also comes in at 117.87. So those look like doable areas for the euro in this most recent rally. So we could get up there. Let's see, the pound's just absolutely screaming, and we're coming into some resistance, pretty good resistance here. And this is the, I may be mistaken here. Let me just, yeah, this is also the 38% retracement of the entire move down. That comes in at 133, just basically 133, and we're almost there. So that's going to offer some near-term resistance for the cable. Again, if you guys are selling dollars, you need to be aware of these pretty key levels we're coming into, okay, across the board. So hold on really fast. Let me just see here. Making some adjustments. Okay, let's take a look at the Aussie. Now the Aussie, we've been talking about the Aussie, you know, with the recovery rally, we're still moving higher. We're actually at highs of the session, but it's not following at quite the rapid rate that the euro dollar is moving, but we are at a 50% retracement. This is a inverted head and shoulder pattern, which we talked about yesterday, obviously, as it's all drawn out here, but let's see how far that extends us. Your neckline is actually right here, right there. Right? So the inverted head and shoulder pattern actually points us all the way to 73.75, and we're at 72.83. So we got plenty of room to run on the Aussie if it wants to continue higher. I mean, if the dollar continues to, you know, get clobbered out here, you know, it's got a lot of room to run. The Kiwi broke this downtrend line yesterday following the GDP numbers. Like I said, I went long, and I went long earlier yesterday at post GDP numbers when we were at 66.40. I took it off the table, but we're still extending those gains. We're actually at the 78% retracement. Let me delete this. Oh shoot, that's not what I wanted to delete. We're almost at the 78% retracement that comes in at 66.80, so some resistance coming up there. For what the hell just happened to the Canadian? Dollar Canadian's actually struggling as we check this out. The dollar Canadian was we were just trading in the 90, around 90, and we just popped about. This thing's getting a little resilient down here. I think a lot of people are scared to be short the U.S. dollar Canadian as we approach the support, knowing that NAFTA deal is not done, not yet. Anyway, so you probably have some, you know, some people that are like, okay, I'm going to just cover up some shorts here. We are approaching channel support, which comes in around 128.50. I actually have some bids down there, just so you guys know. Dollar Swiss, we had big rejection at 97 cents yesterday, if you don't recall. I actually was long, took it off the table at 96.90, and via the pattern in play yesterday, the dollar Swiss, took it off at 96.89. Let's see here. The euro's starting to stall on it. Like I said, this is going to be a little problematic for the euro as we get up towards these levels. Again, we're getting really close to the 38% retracement. The problem with the euro, just intraday, we hit new highs in the reverse. So be a little bit more careful up here. Peso stopped going lower. See, the peso stopped going lower. The dollar Canadian's not going lower. It's kind of stalling, which suggests that, again, I'm going to point out, gold hasn't broken out, silver hasn't broken out. Bond yields are flying. Bonds are just absolutely like the 10-year, 30-year, 2-year, 5-year. The whole curve is dumping, and yields are ripping. Stocks are rallying. I don't know why, but if the stock market starts to notice that bond yields are going higher, then we've got a little bit of a problem. Okay, and then you might see the dollar start to show a little bit of reversal. You might see stocks stall, and then the dollar start to catch a bid. So that's why I'm looking around and I'm like, this seems more like a stop run more than anything at this point. US dollar, Norwegian krona, dovish hike, and the U.S. dollar Norwegian kroner went higher. Now we've pulled back to basically where we at during the Norges Bank decision, but you have to be a little careful because there's already an underlying bid there. U.S. dollar Swedish krona has been destroyed today, absolutely demolished as we came through this trend line here. And the U.S. dollar Japanese yen is pretty much unmoved. Now we have stalled at the 78% retracement, and with gold moving higher and silver trying to move higher, that you would think that would cause the eventual breakdown of the U.S. dollar Japanese yen. We just haven't seen it just yet. We haven't, but the dollar yen might be at a little bit of a risk here. And like I said, I'm actually, and as we first came up here, this is what I was illustrating with you with the New Zealand yen. You got to pay attention to some of these. I think New Zealand yen is just one pair. Probably got to take a look at some of these pairs, like the euro yen. We're pushing right up into resistance here, even though we got a bull flag pattern. Euro yen's pushing right into some resistance right there. The pound yen right up into resistance as well. A very divergent relative strength on a 4-hour chart. Aussie yen continues to scream higher, but we're closing in on the 618 retracement and also some resistance. Again, if stocks start to show some weakness, and I know I've been saying that a lot just over the last few minutes, but look at, you know, the stock market screaming higher for why, you know, for why. I want to show you guys something else. We had this discussion yesterday about inflationary pressures, right? This was an article in CNN Money that actually I saw it on Twitter, but it reminded me of the conversation we had yesterday about where we're going to see the trade war really hit. And it's going to hit our retailers. And I was talking to you guys about my wife's company and how she got hit, you know, like 20% tariffs on some goods that were coming in, or some box shipments that were coming in from China, and just this week. And I mean, it's going to really start to impact retailers, which therefore is going to impact the consumer on a bunch of different levels. It's going to impact them from a consumer spending, but more confidence and inflationary pressures. So that's why I'm a little skeptical about you know, equities being where they're at. I think equities just continue to squeeze shorts, but at some point they're gonna start to feel the pinch from the trade war between China and the U.S. So, and then if stocks roll over, you know, what's the dollar response from there? And I think the dollar response could be actually stronger. All right. Anyway, just some food for thought for you guys. Now, let's go back to the euro dollar. So the euro is closing in on this. Yeah, we're just kind of struggling up here. We're going to struggle as we approach this 38% retracement. This is a big level of resistance, any which way you slice it. We're up against some really, really key resistance here. I mean, we're 10 pips away, 10 to 15 pips away, but you know why we're stalling. There should be no, you know, if you're trading the euro dollar, you should have a really good understanding of why we're stalling, where we're stalling, and it's just basically pushing us right into some resistance here. Now I'm going to turn things over to my colleagues. Stelios, I don't know if Steve is here today.
Hello.
Hey, Stelios, how you doing?
I'm very good. How are you?
Good.
Hey,
good.
Blake.
Hey.
I'm here as well, but I need 2 more minutes, and I'll be.
That's fine.
Sure.
That's fine.
Yeah,
I have a couple of things to say if you want.
No, yeah, I was gonna say. So we got all this dollar weakness this morning, Stelios. Oh, actually, gold just hit new highs. So we got all this dollar weakness coming through the market. How do you feel about everything that you're seeing right now?
Well, it's, the dollar weakness is almost like a lagged reaction to what's been happening with the trade wars, which I think is the main issue here. And the markets seem to have kind of brushed them aside for weeks now, and slowly I think people are realizing that this is going to feed through the economy, and it's not going to be good. So, why the timing?
I mean, you're saying that in the dollar, but but look at the S&P intraday. We're at all-time highs.
Yeah, I know. This is weird. Stocks, U.S. stocks, I do not understand. On this fact that you just said, and also on what Paulie said before, rates, and you said it, rates are going higher, yields are going higher, stocks should be going lower, and they're not. Why? I have no clue. That's why I'm not trading them at the moment. But they seem to be on a planet of their own, basically. So
yeah, I'm curious to see if they're going to take notice of this this move higher in rates, because with rates going higher, and I was just mentioning with the inflationary pressures that are going to be coming down the pipe. Now we know they're coming. These trade wars and these tariffs are really going to start to impact. It trickles down to the consumer. So, and then which is going to affect consumer spending. It's going to slow that down, and it's going to really affect consumer confidence, which is, really the backbone of the U.S. economy is spending. Yeah. So, when will the stock market take notice? And more importantly for us currency traders is, if it does, how does the dollar respond to that? I mean, but look at these moves. I mean, the pound, we had great retail sales in the UK today, right?
That is correct. Yes, it beat expectations. So, revisions were higher as well.
Yeah, so we've gone from 131.50 all the way to 130. We're almost at 133 this morning.
Yeah.
I mean, that's a pretty incredible move for the cable in an intraday setting. And matter of fact, the hourly RSI is probably the highest I've seen it. Well, as far back as I can go on this particular chart, we are registering an 86 on hourly RSI, which is probably a little overdone, I would think. Yeah. So if you're long, you've got to be a little bit careful at this point, I would say. So what else are you seeing this morning?
The other thing I wanted to mention about sterling in particular is that we had a headline from May saying that there is not going to be a Brexit decision or agreement in October, and she pointed out that there is a meeting planned between the UK and the EU some date in November, from what I remember. But what I want to say is that it seems, following May's previous comments from yesterday, it seems that there are she seems to be gaining some power, or at least she's projecting a position of power, which is very interesting, because for weeks and months it had always been the Europeans seemingly having the upper hand in negotiations. So this is actually quite interesting to follow. But as I've said yesterday, nothing's changed. I think it's all constructive for the moment, even though there's a bit of ping pong going from one side to the other.
Right. Well, hey, by the way, just let you guys know, we have Philly Fed and jobless claims and that are coming out. And so just heads up, we're looking for an 18 reading for Philadelphia Fed. It's much, that's the one I'm really paying attention to versus jobless claims. Jobless claims are really, they haven't moved the market in, years. Let's see. So Philadelphia Fed has not come out. Job initial claims came in better than expected. Wow. Philadelphia Fed's actually a pretty strong number. So
yeah, double the previous number.
yeah, it's a pretty strong number. I mean, the dollar is not responsive yet, but
it's actually worth looking at the details. Employment is higher, new orders is much higher, but prices paid is much lower, which is interesting.
Well, that's gonna change.
Yeah,
that's gonna be a little bit different moving forward. But anyway, well, hey guys, I'm gonna pass it over to you. But before I do that, I just need to mention, if you guys are not ForexAnalytix subscribers, you don't see all these active patterns in play that we have here. You're not involved in our, this is our private chat room that we have with only Forex Analytics subscribers, where you can see there's 76 of us in there right now, which usually it's about 60 to 100 people in there at all times. If you're not a Forex Analytics subscriber, make sure you do so. It is our offer that we do like once a year, where we offer an amazing subscription rate, and it's buy 1 month get 1 month free, buy 4 months get 2 free, which is a semi-annual, or buy 8 months get 4 months free, which is our annual subscription. We only do that like once a year. So, and it's going to be good until October 1st. Well, actually the 30th, September 30th. So make sure you guys get involved with that. I'm going to pass it over to you guys. And Steve, welcome back. Glad to have you back.
Thank you, Blake.
Thanks, Blake.
Nice to be back. And, finally we're getting some movement in the markets, right? So it's starting to get interesting. Let's hope it goes on like that.
Absolutely.
Steve, before you go on, I have 2 things to mention, if that's okay with you.
Absolutely. We have time ahead, so whatever you need.
Okay, I can talk about the weather as well. No, I'm kidding. Okay, so.
No, absolutely. Or football or whatever.
So today we had 2 central bank meetings. We mentioned them, Blake and Paulie mentioned them earlier. We had the Swiss National Bank, which kept rates on hold at -0.75% as expected. The interesting thing was that they cut the inflation outlook. 2019, they cut it by 0.1% from 0.9 to 0.8, which is not a lot. But for 2020, they cut it from 1.6 to 1.2%, which is, it's punchy. It's interesting given, yields rising globally. But that's what they did. And also, they explicitly said that the Swiss franc is too expensive, is overvalued. So they seem to be at every opportunity wanting to keep the Swiss franc lower in terms of exchange rates.
Yeah, I mentioned it the other day. As you were saying this, I switched to the euro, to the euro Swiss. I think that this daily candle here was probably an S&B intervention. We're also seeing here the potential of an inverted head and shoulders formation. Ideally, my downside target was at 110.70. We didn't exactly make it there, but yeah, to be honest, the risks are tilted perhaps for a rebound here in the Euro Swiss. Now, having to do with them downgrading their inflation target for 2020, you know how much I value these kind of estimations, right? I mean, they have. The answer is that they have absolutely no clue where inflation is going to be in 2020, as they have no clue where anything else is going to be at 2020, because looking so far ahead in the future without making other assumptions is impossible. So whatever assumption you make, in my opinion, no matter how good your data is, it still has a low chance of coming through, because you're estimating by more or less assuming that you'll have no shocks to the economy, you'll have no major global events, etc., which, if we're talking about a period of 2 years, that's a huge period of time to be talking about. And so yeah, whatever.
And the interesting thing is that the Swiss National Bank it's a really great position. They issue debt at 10 years is 0%, and anything below is negative. So they issue debt at profit for them, right? So they get paid to issue debt. Yeah. Then they sell the francs, they convert it to euros or dollars, and then they go out and buy Apple shares and
stocks,
all that.
Which
is really nice. Yeah. I wish I could do that.
Yeah, to be honest, I've said that before, Stelio, having to do with the S&B, I think that, if Swiss citizens have proved something, is that they're quite politically conscious, okay? And so far, everything has been going according to plan, and the S&B has been making a killing because it's actually been buying risk assets while we are at a very frothy period, while we're in an expansion, especially having to do with stock markets. I mean, huge bull market, which already completed a decade of nice returns. So, so far so good. Now the question is, what's going to happen during the next recession and the next stock market crash, which inevitably is going to happen, because I don't know if there is somebody here that believes that the central banks will actually manage to eradicate business cycles. Personally, not only I don't believe that, but I do believe that they actually, with their actions, they exacerbate them. So they make the recoveries longer than they would be, but they make the crashes a lot more severe than they would be. So let's see what's going to happen when the S&P is actually going to start reporting to the Swiss government that they actually have losses that need to be covered.
Yeah.
So, let's get to that and see what's going to happen then.
Yeah, and if you think about it, the S&P is effectively a big hedge fund, right? And they've done very well, like you said. So if things start turning, they will have no problems letting go of a big number of stocks that they hold, because they're still going to be massively in the money. So
and that's one more thing, one more element that will do exactly what I just said, exacerbate the turn.
Yeah. Okay. And the other thing I want to mention. Sorry?
Yeah, the second central bank.
Yes.
Yeah. You were about to,
Yes, the other thing is Norges Bank. Again, Blake and Paulie mentioned it, I think, passing by. They hiked rates to 0.75, so they hiked 25 basis points as broadly expected. But the interesting thing was, in their statement, they were dovish. So it was a dovish hike. They shifted the forward rate path, and they signaled that the hikes are going to go slower than anticipated. So I think, if I recall correctly, they signaled 2 more hikes until the end of 2019, which is quite slow, given that the inflation rate is at 3.4% year on year and moving higher, compared to the target of 2%. And growth is okay, unemployment is amazing. The country is doing well. Oil is at $70. Before the Norges Bank.
This is simply a game of pretense, mate. You know how it is. Everybody else is trying to keep their currency subdued.
Yeah.
So they're playing the same game. I mean, it doesn't matter if they have actually the evidence or the numbers that are needed to play dovish. It doesn't matter. You just pretend. Pretend and extend this kind of monetary policy attitude. That's it.
Well,
and
it doesn't
the
make
market
much
is
sense.
delivering.
Yeah. And the other thing they actually said is that they were, I can't remember the wording again, I can look it up, but they said they were slightly worried about the prospects of rates going higher and the effect it's going to have on the economy. I mean, of course, high rates have an effect which kind of pulls the economy back a little bit, but that's the purpose of
I want to see when the first central banker is going to come out and say, I'm a little bit worried about low interest rates and what that can do to the economy.
Even though they've had 10 years of evidence.
Hint, create bubbles.
Yeah. They have 10 years of evidence of low interest rate environments, of what it does, and they still don't seem to want to fight it, which is very odd. Central bank, their mandates, most of them, is inflation primarily, and some have a second mandate for employment. It has nothing to do with the stock market, has nothing to do with house prices, nothing. But
these are very interesting conversations for me, and I'm sure for some of our listeners as well. Let me close by saying one sentence before we go to technical analysis. I've said that before. It's like what we were saying with Turkey and hiking rates, that they should have done a lot earlier. The problem remains the political cycle. Nobody wants to swallow the pill, to get a bad situation in their hands so they can avoid getting a much worse situation in the future. So every politician is trying to make sure that, the hand grenade doesn't explode in their hands and they can pass it to the next one. Of course, inevitably, at some point it explodes, but, it has become like a nuclear problem and not like a simple hand grenade problem by then. So, we'll see how that's going to work out. I'm not very optimistic. Having to do with the USD NOK, to go back to our technicals, this kind of a candle is quite a bearish candle, because we got like a big recovery. If you remember the day before yesterday, I actually mentioned the USD NOK, and I said that, since this move now looks quite impulsive and we sliced through 820, I believe that any rebound to 820 should actually be sold, because our initial scenario for perhaps, an orderly pullback to 820 is now out of the window, so we should be looking for further weakness. So today, you know, if anybody wanted, they had the opportunity of actually selling at a good price USD NOK. I do think that the next move will take us to 8 likely. I kept saying for several days that I expect that sooner or later the DXY is actually going to move lower. If you remember in the company meeting that we had the day before yesterday, we were discussing about making a blog post, and we would have actually released it yesterday if I didn't have that incident with my back. I'm actually going to release it in an hour or two from now, having to do with the Euro USD. With Grega, we said that, you know, we both believe that the Euro USD is going to move higher, at least initially. I've said the same thing here on the webinar, and that's what we're seeing today. So finally today we're seeing the manifestation of this move. I actually believe this move today. I mean, I don't believe this is going to be another day that we're going to retrace back the gains later in the day. So I do believe that today we're getting a genuine breakout from the Euro USD. And as you see, we're finally clearing this little base that we had created at around 94.50 in the DXY. So this is the move that we had drawn. We were expecting that when this happens, we should get a move back to 92.60, 92.70. This has been a very important support resistance zone in the past. The 200 daily moving average has also entered this zone as well, and slowly creeping higher. So it's currently at 92.58, but every single day, you know, it's creeping a little bit higher. So I expect that this confluence of supports will act as a magnet, and I expect that it should be tested. So I do think that today's candle, which is quite bearish, you can see this is a long black candle so far today. I do think that you have to respect it, and I don't believe that this is a false move lower. I do believe that there is more weakness ahead for the dollar, even if this proves to be just a corrective move. So even if this is just a correction, I think that we can easily, you know, make it back to 92.70. I was also showing yesterday that, you know, depends on how you look at it. This also is a head and shoulders formation here, right? So, you know, even if we project this target, should at least take us there, if not more. Anyhow, it might be a little bit more, but I don't really care to measure it because, as I said, for me, this is a critical zone. So let's first make it here to 92.70. And, you know, according to what happens from there and according to what kind of momentum we're seeing, we might even start talking then about like a tradable high here. So, you know, we might 100% switch in selling rallies from that point on. So we're seeing this move. I wanted to show one more thing, and it has to do with the cable, actually. I know that Paulie covers everything, but for me, you know, I was 1/3 of a position long cable. I still am, actually. I was, you know, I was considering this quite experimental as a move, but, you know, it felt good. I believe that there is a lot of momentum, you know, that can come up if actually people start getting squeezed, and that's what we're seeing. I was monitoring this ascending channel because for me, a breakout from this channel is proof that something bigger might be, you know, brewing here. So we did finally break out from here. So we might get even a stronger recovery than initially I was looking for this area. We're almost there. This confluence of this horizontal resistance area and the 38.2 at 133.17. We're almost there already today, but, you know, seeing this momentum and this breakout from this little corrective channel, I do think that we might actually make it even to 136 eventually. So, but, you know, one day at a time, let's first clear the 38.2. I might actually close my position here, hoping for a pullback, although this candle is too strong. I mean, my initial thought was taking some profits, all of them probably, because this is a small position at 133. But, you know, seeing this momentum, I'm even considering. I mean, you know, this looks quite a strong move. So I want to see what's going to happen by the end of the day, and I'm going to decide by then. I still have my gold long as well. Hasn't been doing much. I mean, I'm a little bit in the money. My cost average is at 12. What is it? Let me have a look, because I'm now at a different computer. But 11.99, yes, okay, 11.99. So I'm going to show gold and the other metals later on, but let me first finish with cable. So I do see the potential of a larger recovery in the cable, and that's what I wanted to talk about. Now, having to do with the Euro USD, we switch to Euros. Let me switch back. I do think that this is a genuine break. This is what we're looking for. To the previous days, my main scenario was, a move higher from this, and this is also an inverted head and shoulders formation. So I like this 50% fib. Why? Because it's a 50% fib, and the 200 EMA is slowly confluencing there. I believe that by the time we make it up there, if it's not extremely fast, it might be almost a perfect confluence of the two of them. So 119.30, why not? Even the 61.8 can possibly play out later on, but I do think that we should make it there if today's candle gets confirmed, which my gut feeling tells me that it will. I mean, I do believe that there is now a huge chance that we're actually finally going to close above this 117 area. So having said that, let's have a look at the metals, because the metals are actually moving. Gold and silver not so much. I'm going to start by showing those, but the others are moving quite a lot. So gold still consolidating. I'm still of the belief that this consolidation should or could easily get resolved by another push towards 1238 silver, and then I'm going to show the rest, which are actually moving quite more. Silver still finding trouble clearing this 1430, 1435 previous support, current resistance area. So I want to see that level get broken first. If that happens, I do see the potential of even rebounding towards 1520. So there is going to be at least like 80 to 90 cents of more upside. Keep in mind that we have some very nice RSI divergence here on the daily, quite a reliable one as well. I mean, this reading that we had here was almost at 20, and we're currently diverging by seeing readings above 30. Okay, so this is a nice RSI divergence. And now let's have a look at the rest of the metals. Copper has already broken out from this descending trend line. It has stalled at this horizontal support resistance area, but to be honest, so far the couple of candles I'm seeing look to me more like a consolidation before like showing some follow through to this huge outside white candle that we had a couple of days ago. So I think now the chances of actually clearing 274 to the upside and perhaps making an effort to retest the 294 breakdown area is a high probability. And as expected, I kept saying, here it is, palladium. As I was saying, I strongly believe that palladium is going to have its next move to the upside, because initially I was looking for this as an area that palladium would fail. And then we kept saying last week that, this type of a consolidation does not look anymore like finding resistance, failing and moving lower, simply because it was, coiling price action after quite a strong V-shaped recovery. So I said, the chances day by day are increasing that we're finally going to see a break higher from the 1000 level, which is also like quite a nice psychological level for the market. So we're now attacking this previous high at 1058. Needless to say that now this move has now transpired. Any pullback, let's update this chart. Any pullback towards 1000 should be considered a nice buying opportunity, because this zone can start acting as support from this point on. So very nice V-shaped recovery. All in all, I've been showing this for a long time. This looked like a corrective move at a very, very strong uptrend. You can see it. I mean, I kept showing this chart saying that, this move lower doesn't look, in the grand scheme of things, impulsive. It actually looks corrective. And I think that this move that started from the 833 low to where we are already at, on the other hand, does look impulsive in nature. Okay, so pullbacks I think should be bought. Just look at the RSI approaching 80 on the daily chart. That's also a sign that, yeah, we're overbought in the short term. I'm not advocating that somebody should be buying it here, because we should see a pullback sooner rather than later. But I think that also this RSI reading is showing that the path is higher now. So, you know, a pullback, especially if we make it back to 1,000, great buying opportunity. Now, the other thing I wanted to show was Aussie and Kiwi, because both of them are actually approaching very nice, interesting levels. They both created inverted head and shoulders formations on the 4-hour chart. I was talking about it the other day. They comfortably, you know, cleared the necklines, and Aussie is currently about to test this descending channel's resistance. You know, we've been trading within this channel since actually the first days of the year. So it's already like 9 months that we have been respecting this, meaning that, you know, if we get a break above this, let's say roughly 73 level, if you want to play it a little bit safer, let's say 73.20, 73.30, because, you know, we had those lows there. I think that there is a very good chance that the rebound is going to extend higher. Same deal here with the Kiwi. Kiwi found resistance at the triple confluence, support at the triple confluence of supports. It's rebounding nicely. I think especially if we clear this 67.20 area, we're going to be looking at a bigger upside towards, at least in my opinion, my next target is going to be at 68.70. So, you know, another 150 pips in my mind, more or less, are going to be guaranteed to come. If we clear that level, I believe a lot of stop losses should be residing there, and only by triggering those, we should comfortably see a continuation higher. So both of them are looking quite nicely. Now, let me go to have a look at the indices a little bit. You know, we're breaking up in the S&P, which isn't a surprise at all, because as I said, S&P was looking very bullish to me. I mean, other indices were looking better for a possible breakdown, but the S&P, I mean, this was a textbook consolidation in a bullish trend. I would be still careful though, because I'm monitoring this ascending channel, and, you know, we're once again about to push its resistance. It's currently roughly at 29.32. So let's say roughly 10, 12 handles higher from where we currently are. Blake was mentioning before that this move higher in stocks doesn't make sense. I mean, we've seen the market getting spooked in the past from this breakdown in the treasuries, or if you want to see it opposite, from this move higher in the yields. So let's switch to them so I can show it. And what Blake didn't mention is the fact that it's also a matter of opportunity cost, right? I mean, the higher the yield in the treasuries, the less appealing holding stocks, especially at these valuations, are, because dividends are now lower than the treasury yield. Okay, I remind you that this is the yield chart. We were talking about it, and we were saying that, listen, the main case scenario here is a break higher from this triangle, because this is probably a triangle after getting a very nice breakout from this inverted head and shoulders formation. And the only bearish scenario having to do with yields was actually seeing this potential head and shoulders formation break down the neckline. But, you know, we had stressed out that the main case scenario is a bullish consolidation. And, you know, several days ago when we actually started breaking higher, you know, we said that, okay, it looks like, you know, what was the main case scenario is playing out. We seem to be breaking up in yields, and let me show you now the treasuries themselves, which are of course inversely correlated. You can see here the treasuries, that the treasuries have broken down from a triangle, and downside targets are now opening up. We're about to test the previous lows. In my opinion, a move, I always like the 161.8% extension. So a move towards this 116.5 roughly area is very likely, which means that, you know, it looks like we're going to get a fresh multi-year high in the yields, fresh multi-year low in the price of the treasuries. That should, theoretically speaking, spook the markets again. It's also a matter of opportunity cost, as I said. So in all honesty, I agree 100% with Blake. I don't trust this move higher in stocks. Doesn't look very logical to me. We are already anyhow overbought, by a lot. So I would definitely not be chasing the market up here. Dow Jones, approaching the all-time high. It's one of the few indices actually that hadn't already broken above it, but I'm monitoring this potential ascending wedge. Nasdaq seems to have broken below a wedge, but we have seen no follow through yet. So I'm still very skeptical that we're going to see a new high. And I like the fact that the S&P is pushing new highs and the Nasdaq is diverging, because I remind you that the strength kept coming for a long period of time from the Nasdaq. So I like this kind of a divergence. And if we see the S&P push to a new high while Nasdaq is still diverging, and then we see S&P roll over, I'm probably going to be selling. I mean, I'm already itching, to sell. I sold the other day, and just a quarter of a position, and I took profits actually at the lows. That was quite lucky. As a little scalp, which I very rarely do, but that's how I felt about it. But if we see the conditions that I just mentioned, I'm going to actually sell a full position here, but not yet. Not yet. So Stelio, I don't know if you're still here, because I know that you had to go. Okay, he's not. So let me have a look at a few of your questions, if we can cover them. Let's see. Yeah, Joe says, since when do stocks act logical? And he has a point there. A friend here is asking about my views in the VIX, and we have a question about CAD as well. Okay, let's have a look at those. So VIX, it's good that you asked, because actually it's a nice idea having a look at the VIX, given the fact that we were just talking about stocks. I can't stop thinking that we are seeing, first of all, we are obviously we're still seeing a divergence in the VIX, right? Why? Because we are at all-time highs in the vast majority of the indices, but we are far away from the lows that the VIX was hitting back at the end of last year, right? We even made it like to almost 8.5. We're currently trading constantly above 10, and I'm monitoring this triangle for a potential breakout. I think that if we actually break out from this triangle, this is going to be a nice confirmation about what I was just saying, that perhaps, after trapping a lot more people long, we're going to get like a big move in the other direction. Now, having to do with USD CAD, let's have a look at it. Okay. I think this is a complex correction of some kind. I mean, we're still trading above this broken trend line resistance in a manner that so far isn't impulsive, right? Just look at this. I mean, very choppy, very overlapping price action. So as long as we stay above, now we have, this broken descending trend line is now actually more or less confluencing with another couple nice of supports. One of them is the 200 daily moving average, and the other one is the 61.8 from this move higher. So I would be watching this 128.50 with, being very careful about it, right? So I wouldn't be selling USD CAD here, right? Not as long as we remain above 128.50. But you know something, even if we do break below 128.50, if you want to be short the dollar, I see better opportunities out there, right? So personally, I would not, I'm not even looking to trade anytime soon the USD CAD. The only way I would trade it soon is if we found some low in the dollar and we actually got some nice reversal for the USD CAD, for example, at the level I just gave, which is a very nice triple confluence of supports. Now, if something like that happened, yeah, I would probably you know, strongly consider the possibility. But until something like that happens, I'm not. I'm still monitoring it. I still see the potential of it resuming to the upside sooner rather than later. But you know, I'm not willing to take it any further than that. So anyhow, thank you all for being here. I think that, you know, we might have some follow through. And you know, we were about to actually release a blog post yesterday, but I couldn't finish my part because, you know, I had my back issues. So I'm going to do so now. So keep in mind, our blog is free for everybody to see. If you go to ForexAnalytix, to our homepage, and you click on the blog, you should see that it is here. Here it is, blog. So you know, within the next 1-2 hours maximum, you should have a new blog post here that has to do with the Euro USD. Okay, so thank you all very much, and we'll be here tomorrow again as usually.